Okay, let's dive into this. Imagine the biggest capital market there is, mortgages, but one that was described as being sheltered from the normal processes. That quote's from Dick Pratt way back.
Yeah, sheltered. It sounds almost like some huge, complex, unstoppable force.
Exactly. But the sources we're looking at today, they tell a different story.
Yeah.
It wasn't inevitable, this financial crisis. It seems more like, well, a chain reaction. Failures, decisions, risks people took, often driven by, ambition and money.
And what's really interesting is that the material you've got here, it's like a roadmap. We can actually trace the hidden history, starting from the real nuts and bolts, the early mortgage finance stuff, government policy, all the way through to the bleeding edge Wall Street innovations and the big regulatory fights. It's not just the crash at the end, but what built up to it, the conflicts, the people, the blind spots. It all came together over decades.
So our mission for you in this deep dive is to pull out those really key insights, those nuggets of knowledge, straight from these sources. We want to help you see how all these different things that might seem unconnected, actually layered on top of each other to create that perfect storm.
So where do we start? If we're building the picture, we kind of have to go back to the beginning of mortgage finance, right?
Right, let's call this part one, building the machine. And the problem at the very start was actually pretty straightforward. Inefficiency.
Yeah, basically money for mortgages wasn't spread out evenly. Some areas had lots of capital, others just couldn't get enough.
And that's where the government stepped in. Created Fannie Mae, then Freddie Mac, the GSEs, government-sponsored enterprises.
Their job initially was clear. Link up those local mortgage markets with the big national pools of money and, importantly, boost homeownership. That was the goal.
And it worked for a while. But then came a really big change, 1968. Fannie Mae splits off from Ginnie Mae, becomes this, quasi-private company.
Quasi-private, exactly. And that meant it could buy conventional mortgages, issue its own securities, and suddenly you have this tension, right? This sort of vague social mission homeownership right up against a private company's need to make a profit.
And that's when Wall Street really spots an opportunity. Lou Ranieri at Salomon Brothers, he's a huge name here.
Oh, yeah, the father of the MBS, the mortgage-backed security, huge excitement, big fees. But Ranieri and others, they also wanted to, push back against the GSE's dominance. They saw this huge market controlled by Fannie and Freddie.
So it wasn't just about new products. It kicked off what these sources call a quiet war. Wall Street, represented by people like Ranieri versus the GSEs like Fannie Mae under David Maxwell.
Exactly. And you saw legislation like the Secondary Mortgage Market Enhancement Act, SMMEA. It was supposed to level the playing field.
Supposed to.
But as Claude Pope Jr. testified, no truly private company could really compete because Fannie and Freddie had this implicit government backing. They could borrow money cheaper. That's a massive edge.
A huge edge. So Wall Street needed something else. They really pushed for tax changes to let them create these multi-class securities. Remix, they were called. Real estate mortgage investment conduits.
And Ranieri saw Remix specifically as a way to potentially, and this is a quote, outprice the agencies if the GSEs didn't get the same deal.
So the fight intensifies. Wall Street, big S&Ls, they line up against giving Fannie and Freddie ERIMIC powers. They argued it would just crowd out the private market completely.
Right. And Fannie under Maxwell, what do? They wrap themselves in the flag of home ownership. They argue, look, our low costs help consumers. These guys just want to bring back inefficiency for their own profit.
Wow. So this whole incredibly complex system we ended up with, it really started with this fundamental clash, didn't it? A government goal versus private ambition fighting over who controls this giant market. Understanding that early fight, the innovations that came out of it, that's crucial background. It wasn't always this way. It grew out of these battles.
Absolutely. And while that machine was being built, you had a whole new group of players and, frankly, new practices showing up, especially in subprime.
Yes, okay. Let's shift to part two, the rise of subprime. And when you read about this period in these sources, two names really jump out. Angelo Mozillo at Countrywide and Roland Arnall at Long Beach, which later became Ameriquest.
Mozillo, yeah. He's painted as this sort of underdog figure, really resenting the establishment. There's that story about him being refused service, him being Italian.
Right, the Virginia Beach story.
Yeah.
And that experience, the sources suggest, really fueled his drive. His former partner basically said, Angelo will do whatever it takes to be number one. Just pure drive.
And Arnall. He was more focused on just charging high fees, used lots of independent brokers, and later he got big into selling the MBS backed by those loans. And subprime lending, loans to people with shaky credit, exploded then.
Yeah.
Mostly through that broker channel.
The numbers are kind of staggering. According to the Fed and HUD Treasury report cited here, the number of subprime loans up like 6 times the dollar amount, up nearly 5 times, just between 94 and 99.
Wow.
Huge growth. And, on one side, this is credited with pushing home ownership rates up to record levels, like 66.8% by 99.
But there's a huge but right there in the sources, isn't there? That same report points out that the overwhelming majority, 82% of those subprime loans, were actually refinances.
Not buying homes, refinance.
Exactly. And almost 60% of those involved taking cash out. So people were adding debt, not building equity, which is what folks like Rosner were warning about. Mozilo, though, he seemed to genuinely believe the homeownership goal lined up with his business, his history, pointing to things like redlining that kept people out before.
But the way it was done, some of the practices described are pretty disturbing. A Justice Department investigation found Long Beach brokers tacking on massive fees up to 12 points that had nothing to do with risk.
And it was discriminatory. Younger white guys got the best rates. Older, single African-American women got the worst deals. And other lenders mentioned New Century. Option 1, they're described as these freewheeling entrepreneurs who worried, quote, less about bending the rules.
And the loan products themselves? Yikes. The sources call out these pernicious 228 loans. You get a low teaser rate for 2 years, then bong, it jumps up for the next 28.
Right.
Often with big penalties if you tried to pay it off early.
Or those pay option ARMs, where your payment might not even cover the interest, so your loan balance actually grew over time.
Negative amortization, yeah.
WAMU did focus groups. Customers said they felt scared, felt this impending doom. They wanted to pay down the principal. But Wall Street loved these things. Why? Fees. WAMU apparently made 5 times the profit on an option ARM compared to a regular prime loan.
5 times. That says it all about the incentives, doesn't it? And the culture inside some of these places. It sounds awful.
Yeah.
Ameriquest described as a chop shop.
Like Glengarry, Glen Ross, yeah. High pressure sales, power hours. Managers described as brutal. They'd hire inexperienced people, the quote is car wash guys, who maybe wouldn't even realize they were, quote, screwing people over.
There's even that story about blindfolding employees in training, like something out of Boiler Room.
It paints a picture of a market just chasing volume, chasing fees, taking a legitimate goal, home ownership, and twisting it to load people up with debt using really aggressive, sometimes predatory tactics. You really can't grasp the crisis without understanding that environment.
You really can't. Okay, so that's happening on the ground with mortgages. What's going on back on Wall Street with the big picture stuff? Innovation and regulation. That takes us to the regulatory blind spot.
Exactly. Let's pivot there. Part 3. The regulatory blind spot, derivatives, and deregulation. While subprime is taking off, Wall Street's transforming too. JP Morgan, early 90s, under Dennis Weatherstone. They're moving hard from just making loans into investment banking, trading.
And derivatives become huge. The sources say they became, quote, the basic business of banking for firms like JPM.
And one key tool they developed was value at risk, VAR. Greta Goldman's team created this model trying to boil down all the firm's risk into one single number, the famous daily 4.15 report.
Right. Seems simple. Appealing to CEOs, maybe not deep in the risk weeds.
Yeah, exactly. But maybe even more important for this story, the credit default swap, CDS. Blythe Masters was involved at JPM, creating the first one in '94. At first, they were just internal tools, pricing loan risk, managing capital requirements.
But they saw the potential. Right.
Oh, absolutely. If they could convince regulators that these things really transfer the risk of default, it could open up a, quote, huge market for freeing up bank capital across the whole system.
And despite people ringing alarm bells like Gerald Corrigan back in '92 saying, quote, I hope this sounds like a warning because it is, and scandals involving derivatives popping up.
Procter & Gamble, Orange County.
Right. The sources flat out say the government, quote, never even came close to regulating derivatives.
And it wasn't just that they didn't get around to it. There were powerful people actively fighting against regulation. Mark Brickell, first at JPM, then leading the industry group ISDA, he was relentless.
And Alan Greenspan at the Fed. He had this deep conviction in market self-discipline. Famously said risks are, quote, regulated by private parties.
Right. Even Corrigan, after he left the Fed and went to Goldman Sachs, ended up testifying for derivatives.
Meanwhile, you had Brooksley born at the CFTC. She saw these things, quote, growing up between the cracks in the regulatory system.
She tried to do something, didn't she? Just explore the idea of regulation.
Yeah, just a concept release asking for public input. And the reaction was furious. Larry Summers at Treasury then reportedly was, quote, screaming at her, threatening that business would just pack up and go to London.
Wow.
And crucially, the other big regulators, the Fed, Treasury, the SEC, they didn't support her. They basically said, nope, quote, no failure of market discipline here that warrants new rules.
So Bourne's effort got shut down. And what happened next? The president's working group report came out, and that led straight to the Commodities Futures Modernization Act of 2000.
The CFMA, championed by Senator Phil Gramm, signed into law under Clinton, with Summers playing a key role at Treasury by then.
And Bob Rubin, who Summers replaced, had just gone to Citigroup as a senior counselor.
Right. And that act, the CFMA, explicitly banned regulators from overseeing over-the-counter derivatives like CDS.
So this wasn't an accident. This enormous, complex market was deliberately kept outside of regulatory oversight. Powerful interests, industry lobbying, and a strong free market ideology combined to create this huge space where risk could just grow and grow, completely hidden from view.
And for those risks to be accepted, they needed some kind of stamp of approval. Which leads us to the rating agencies.
The gatekeepers, right. Part 4, the rating agency is the authority without accountability. The sources make a really important point here. Rules pretty much forced big investors, like money market funds, to rely on credit ratings, especially that coveted AAA rating.
So effectively, the bond market was, quote, outsourcing its risk management to the rating agencies. Investors just took the rating, quote, in lieu of conducting a due diligence investigation. They trusted the rating instead of digging in themselves.
And those ratings had immense power, described as having, quote, almost biblical authority?
Biblical authority, but the track record, not so great, according to these sources. They missed huge blowups, New York City's crisis, Orange County going bankrupt, LTCM.
Right, and there's that stunning statistic mentioned. 78% of A and AAA rated municipal bonds defaulted back in the Great Depression. So critics like Frank Partnoy were saying, wait a minute, where's the proof these ratings are actually accurate?
And then there's the massive conflict of interest, right? The agencies were paid by the companies issuing the bonds they were rating.
Exactly. Chris Clarkson at Moody's was pretty upfront about it. Quote, we're in a service business. I don't apologize for that.
Doesn't sound great for independence.
No. And under Clarkson, the sources say the culture at Moody's shifted. It became more about, quote, caring about whether the issuers were happy. Analysts felt pressure over market share. If a competitor gave a higher rating, they had to, quote, explain any rating discrepancy.
There's that story about the analyst megalithic where Goldman Sachs basically asked Moody's not to put him on their deals.
Yeah, that speaks volumes about the pressure, doesn't it? Pleasing the client who pays the bills.
And this pressure, combined with just bad methods, their models relied on really shaky assumptions, like assuming mortgage defaults in, say, Arizona wouldn't be correlated with defaults in Florida, or that house prices wouldn't fall much nationally.
And maybe the most shocking thing the sources point out, there was, quote, no requirement that a rating agency verify the information contained in RMBS loan portfolios.
They didn't even have to check if the loans in the pool were what the issuer said they were.
Apparently not. They just took the issuer's word for it. A former Moody's executive is quoted later saying, quote, we had blinders on. Why didn't we envision that credit would tighten and housing prices would fall? Bubbles inevitably burst. Hindsight, I guess.
Wow. So the very entities everyone trusted to judge the risk, they were compromised by their business model, pressured by clients, using flawed models, and not even checking the basic underlying data sometimes. Yet their ratings were treated like gold. That created this huge false sense of security, didn't it?
A profound illusion of safety, just as the risks were getting packaged into ever more complex structures.
Which is where things really start to spin out of control.
Exactly. That illusion allowed the financial engineers to kick into high gear. Let's get into part 5. The CDO machine goes nuclear debt on debt, packaged and rated. Remember CDOs, collateralized debt obligations. Originally, they were often backed by corporate debt.
Right.
But when that market slowed down, Wall Street got creative. They started creating CDOs backed by those mortgage-backed securities, the MBS we talked about.
Okay, so wait. Instead of just packaging mortgages into an MBS, they were packaging the MBSs into a CDO.
That's it. The sources describe it as 3 layers of debt. The CDO buys the MBS. The MBS holds the homeowner's mortgage. Debt on debt on debt.
That sounds inherently riskier.
Well, they often offered higher yields than corporate CDOs, which usually is a sign of higher risk. But remember the rating agency issue. And the lack of due diligence. People weren't necessarily digging into the actual mortgages buried layers deep. They were looking at the models, the diversification claims, and crucially, the rating on the CDO slice they were buying.
And then it got even more abstract with synthetic CDOs.
Ah, yes. The synthetics. These didn't even pretend to hold actual bonds or mortgages. They were created, quote, solely to make bets on whether other securities would default or not, using credit default swaps.
So just a betting instrument, described here as a, quote, zero-sum game. For every winner, there has to be a loser.
Exactly. And here's where it gets really dangerous and how the whole thing could scale up almost infinitely. Wall Street figured out they could take people making bets against the housing market hedge funds, shorting subprime MBS, for instance.
Right. The shorts.
And they could package the other side of that bet, the long side, into a new security. They'd get the rating agencies to slap a AAA rating on the senior slice of that bet and then sell it to investors.
So they're selling AAA securities that are essentially just the opposite side of the bet that things will collapse.
Pretty much. Selling it to investors who, quote, was buying a rating and thought he couldn't lose money. They often had no idea they were facilitating someone else's short position.
I'm kind of mind-blowing. The sources mention specific deals, right?
Yeah.
Abacus.
Yeah, Abacus, Goldman Sachs, John Paulson, the hedge fund manager. Paulson helped pick the underlying securities specifically because he thought they were going to fail. He was shorting it.
But parts of it still got highly rated.
Yep. The Moody's analyst apparently wasn't even told about Paulson's role in selecting the portfolio he was betting against. Then there's the Norma CDO, Magnetar, involved with Merrill Lynch. Magnetar helped create it, shorted the risky equity piece, while Merrill sold the AAA tranches to investors using pitch books talking about safety. That deal went to junk almost immediately after closing.
Unbelievable. And these synthetic deals, they could just keep creating them.
Quote, ad infinitum. They didn't need real mortgages as collateral, just counterparties willing to take the other side of the bet. It massively amplified the leverage in the whole system. The numbers are just huge. By 2005, Wall Street revenue from underwriting MBS and related stuff was over $5 billion.
And derivatives overall.
The notional value, the face value of all these bets, was already over $50 trillion back in early 1999. It just exploded from there.
So you see how it all connects. The financial engineering, working in that regulatory void, blessed by compromised rating agencies. It took those risky underlying mortgages and spun them into these hyper-complex leveraged bets that spread risk everywhere, hidden in plain sight.
Yeah.
Like that Merrill executive's email asking about a deal. Who owns the risk?
A question nobody seemed to have a good answer for until the whole thing started to unravel.
Which brings us to the final chapter here, part 6. The storm breaks. Warnings ignored, denial, and collapse. By 2006, early 2007, the cracks were really starting to show, weren't they?
Oh, yeah. New Century, huge subprime lender. They suddenly faced soaring defaults right after loans were made, demands to buy back bad loans. They went bankrupt April 2007.
And the ABX index, tracking subprime risk, plummeting.
Even some stuff rated AAA started looking shaky. Quote, a strange wobbliness, as the source puts it, regarding Bear Stearns funds. Lou Ranieri pops up again, warning late 2006 about anger, dismay, worry.
So the signs were there, and some people did see it coming.
Definitely. Greg Littman at Deutsche Bank figured out slowing house price growth was the trigger, became a huge advocate for shorting. Andy Redleaf, hedge fund guy, started shorting early 2006. He said they were, quote, scratching our heads in disbelief that Wall Street wasn't seeing it. He figured maybe at least 20 smart players were short.
But inside the big firms holding all this stuff, denial seems like the word. John Breet at Merrill Lynch warns about billions in losses, gets basically exiled and yelled at.
Jeff Kronthal warned things were overheated, got fired, replaced by traders who said they were cutting risk but actually ramped up volume. Michael Blum questioned the CDO desk's optimism as foreclosures rose. Stan O'Neill, the CEO, apparently bought reassurances that the risk was tiny.
And AIG, that's a whole specific disaster zone in these sources. AIG FP, the financial products unit under Joe Cassano.
Yeah, despite huge pay packages, they got to super risky stuff, securities lending into CDOs, and critically, they sold massive amounts of CDS protection with collateral triggers nobody at the top seemed to know about.
Triggers, meaning if AIG got downgraded or the underlying bonds lost value, they'd suddenly have to post huge amounts of cash.
Exactly. Joseph St. Dennis, an accountant there, got really worried, quote, gravely concerned about the collateral calls coming in from Goldman. $1.8 billion in July '07, jumping to $5.4 billion by June '08. He ended up resigning because Cassano cut him out of valuation meetings, saying he'd, quote, pollute the process.
Pollute the process by asking questions.
Seems like it. Even AIG's auditor, PwC, raised flags about Cassano's methods and the lack of controls.
And the regulatory failures we talked about earlier just continued.
Pretty much. Ameriquest pays a $325 million settlement for abusive lending, but Arnal still gets nominated as an ambassador. Political connections, maybe? State and local efforts to curb predatory lending, often preempted by federal regulators like the OCC and OTS, or tied up in court by lender lawsuits.
Donna Tanu at the FDIC tried to stop banks buying predatory loans, got undermined. Ned Gramlich at the Fed warned Greenspan about subprime, got blocked. WAMU basically ignored regulatory warnings about risky mortgages because following them would cut their volume and profits.
So even as the flashing red lights were impossible to ignore, what did Wall Street do? According to the sources, they, quote, raced to shove as many CDOs out the door as it could in early 2007. Get the bad stuff off their books onto someone else's.
And the rating agencies helped them do it, still giving high ratings.
Still facilitating. Internal emails mentioned show S&P and Moody's analysts knew about the subprime brouhaha and potential problems months before they finally acted with big downgrades in July 2007.
You even see the struggle inside Bear Stearns with those hedge funds run by Schiaffi and Tannen. They saw the market tanking. February '07 was a treacherous month, they said. But they initially clung to this idea that their AAA stuff was safe, that their, quote, careful credit analysis mattered.
Until it didn't. They faced massive collateral calls as their holdings plunged. The funds blew up in July '07. Schiaffi is quoted saying he felt, quote, almost too embarrassed to call a key supporter because his business was just, quote, collapsing.
It wasn't like a light switch flipped off. It was this slow-motion train wreck, wasn't it? Warnings ignored, incentives driving bad behavior, regulators unable or unwilling to step in, all building up to the massive crisis that followed.
Exactly. A deterioration over time.
So, reflecting on this whole journey we've traced, we started with this fairly simple local mortgage market, and we watched it morph into this incredibly complex global machine.
Yeah, fueled by that explosion in subprime lending, operating the space created by deregulation, pushed along by all this financial innovation.
And given that false seal of approval by gatekeepers, the rating agencies, who just weren't doing their jobs properly.
And the sources really drive home that it wasn't one single cause, right? It was how all these things interacted. The policy choices, the new financial products, the culture, the regulatory gaps, the flawed assumptions.
All interacting, driven by, ambition, profit-seeking, sometimes deeply held beliefs about markets.
Yeah.
And just a failure, really, to connect the dots or heed the warnings.
Yeah, widespread failure.
And the picture you get from these sources is one where everyone started trusting the models, trusting the ratings, trusting the idea that markets would police themselves, and they stopped doing the basic homework, the fundamental analysis, and caution.
That trust was seriously misplaced.
So it leaves you thinking, doesn't it? What happens when financial systems, or maybe any complex system, become too complicated for us to really understand or oversee effectively? And what happens when the people or institutions we rely on for objective judgment are compromised? What lessons does this hidden history hold for spotting risks today, in finance or maybe elsewhere? That's something to chew on after this deep dive.